Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
General advice disclaimer. The information provided is general in nature and does not take into account your personal objectives, financial situation, or needs. Before acting on any information, you should consider whether it is appropriate for your circumstances and seek professional advice from a licensed financial advisor. While every effort has been made to ensure the accuracy of the information, it is not guaranteed. It is based on our understanding of regulations and laws as at the publication date. As these are subject to change, you should talk to a professional advisor for the most up-to-date information. Any examples or illustrations provided are for illustrative purposes only and are not a guarantee of future performance. We do not accept any liability for any loss or damage incurred by reliance on the information provided. Any opinions expressed are subject to change without notice. Past performance is not indicative of future results, and all investments carry risks. Neither the hosts, guests, nor any affiliated entities accept liability for any loss or damage arising from reliance on the information provided. By listening to this podcast and viewing this presentation, you acknowledge and agree to these terms.
Good morning, team. I hope everyone's well. Back on Thursdays with finance updates and everything alike. With myself, Alex. I hope you guys enjoy it, and let's dive straight into it. So the interest rates, hey, they remain the same. We expected that. Obviously, the unemployment data that came out a few weeks prior gave us that sort of view, but hey, the RBA will hold it. So, and that's what happened. So what I wanted to do today, guys, is to take you through the announcement. Last time I did that about a month ago, I actually got some positive feedback. I don't know why. It's pretty boring stuff, but I think a lot of people kind of realized, hey, there's actually some info in there that that could be relevant to myself. And then also what we'll do is we'll also check out some of the graphs from the RBA as well. So some interesting data in there. So hopefully that will be interesting. And look, if you're listening on a podcast, you might need to jump on the video and have a look through the info that we'll be chatting through today. So with that said, I hope you have your cup of coffee with you. Let's dive into it. All right. right, can you guys see this? So you can, like, as always, jump on the RBA website. You can see this sort of stuff around here. Like I said, takes a couple of minutes to read through, but ultimately, what's the update? Let me make this a little bit bigger if I can. Maybe I can't. That's all right. The RBA held its rates at 3.6. Very much of a muchness in terms of their message from last meeting. I don't know how about you, by the way, but I got caught out because typically I'm used to these announcements being made on the first Tuesday of every month. And for some reason, it was at the end of September. So anyhow, just in case you missed it, it's here. Look, they basically highlighted that the inflation rate has fallen substantially. So we already know that, and we're going to look at that in a second as well through some of the data that they've provided to the general public as well. They're citing the same things. They're looking at the activity domestically and internationally, and that kind of paints the picture for them in terms of where that will be going with the interest rates. My view is that we're probably done with cuts for the rest of the year. I think that the rebates and all that stuff that are coming to an end, like the energy subsidies and all that, I think that will ultimately increase the inflation over the next 6 months, which would be the trigger point for the RBA to kind of keep that on hold. They're still citing that, the unemployment rate, they'll be monitoring that. That will give them a bit of an indicator as to what to do. They're citing uncertainty globally. We know that it's basically the same narrative as they have previously written. They want to maintain stability, full employment, and whatnot. So nothing new essentially, right? So nothing new from what they have been talking about. And basically, let's just wait what the data says to us. Well, let's have a look at that data because they have actually posted that on the RBA website as well. So it's called the Australian Economy and Financial Markets. So this one is just, it was published yesterday, I believe. So I hope you guys can see this. And let's go through it. So there's about, 30 odd pages on this report. It's full of graphs, right? So I'm going to try to focus on a couple of them that may or may not be relevant. But ultimately, this is a data set that can give you a bit of an idea as to what to look at. And, obviously try to help you interpret some of these graphs as well. So, they'll look at the world economy as step number one. That's all right, no problems. Let's have a look at some of the ones that I looked at earlier and I thought I'd talk to you about. So GDP growth is gross domestic product growth, quite important to look at. As you can see, during the pandemic, that was basically negative, as we know, because everyone kind of shut down. And then there was a huge stimulus out of it as people were sort of moving around. So, and then once the interest rates started to pick up, that's when we all kind of went back into our shell. And, you can sort of see the uplift now coming back from the last couple of cuts here. So let's have a look. Mining activity. Interesting stuff, by the way. So I'm not sure if you saw, but China has banned all iron ore purchases from BHP, which is quite interesting. So, and we're going to see a chart about that in a second as well. We can see the CPI, consumer price inflation here. So this is the Australian. So you can see that, the inflation as we sort of saw about 18 months ago was, we expected it in double digits, but, the reported number was around sort of 7, 8. So, and you can see that has kind of fallen down quite significantly, which is the target band for the RBA. And you can sort of see historically, they're trying to keep between 2 and 3, but 0 and 3 is where you're kind of looking at it. And they've been managing to do that for, nearly 10 years now. And then they had the pandemic, it spiked, and now with all the interest rate increases, they brought that back down. So let's keep going down. Household sector. Interesting stat here. Pandemic, massive savings percentages around that time, and you could see, 20-25% savings in here. It's a pretty decent amount. And then obviously, as we came out of and started moving around, we went and spent all that, which is quite interesting. And you can see that in the last sort of 12 months, the savings have picked up. But again, that's probably on the back of high interest rates. As you're probably aware of, seeing around, people are out and about, but they tend to not spend as much in the cafes and restaurants and whatnot. So, they're looking to save currently. Consumer sentiment is quite important as well. So basically, how positive are we about where things are? So, typically aligns quite close to the interest rates, and if the interest rates are high, then we tend to have a relatively low sentiment, which we can see around here. And historically, because pre-pandemic, the interest rates weren't as high. So, the sort of being at 100 as your baseline is where you want to be. So you can see that, in the last sort of 12 months or so, the sentiment has been improving, which is quite good, but still quite short from where the average is. So hopefully with a couple of more rate cuts in the future, that would change as well. Let's have a look. I think we've got a few people jumped on. Hey, Jeff. Good morning, mate. Thank you for jumping on. Hey, Pat. Good to see you. Jeff, what do we got? Ready for fourth quarter crypto? I don't know if I click on this. Oh, yeah, here we go. That will show up. Albo 5% deposit scheme already driving prices up. Yep, absolutely. Interest rates. Melbourne Cup Day. Yeah. Look, I think that we're going to stay on hold for the rest of the year. But, if I'm wrong, then that would be, I guess, a good result for everyone else. But yes, the 5% scheme that kicked in yesterday, that should potentially, especially in that sub-mil property sector, and I'm no property experts by any means, that should definitely drive that demand up with more people coming to the market. So it's actually a household sector. Let's have a look. I think that there's speaking of that, Jeff, if you have a look, in terms of as we know, the cost of the cost of buying a property has gone up significantly, and you can sort of see that, in terms of the average ratio of your income to purchase is sort of, 2 times essentially. But I think in reality, it's more like 5 or 6 really. So, this is really much on average around the whole population. Let me just get down. I'll skip the business side for now. Skip this as well, I think. Skip this. Yep. There are a couple of interesting graphs here. Hey, interesting here. Employment and hours worked, right? So that's a pretty cool graph. You can see on average that people are working less, right? So perhaps that's where the productivity question comes in, you sort of, the working days haven't changed, but in terms of the output, it's looking like it's on a downward trajectory. So that's what the productivity discussion is all about, getting that back up. People using AI to sort of complete certain tasks. So if they can complete that in, say, 2 minutes, then they sort of take 20 minutes off as a result. Unemployment rates. So you can sort of see where things are sitting. You look at Victoria, probably one of the highest. Probably top two was South Australia in terms of the unemployment rates. Queensland, New South Wales, Western Australia are all sort of sitting below 4% ish. So you can see where the output is. You can see what have we got? The mining sector has dropped quite significantly, as we know, because you look at the lithium, you look at iron ore outputs. China's demand has fallen. The lithium equation has also been on a downward sort of trajectory, with just the influx of various demand. Agriculture is also, historically relatively low, but it's kind of been trending at low numbers. All right, let's have a look at government. What do we got here? The thing is, there's so many graphs. I actually went through all of them, and I'm like, which one do I think would be quite good for everyone to sort of look at? But essentially, when you jump on this, you can go and have a look at different sectors of the economy. How they've sort of broken it down, and just have a look at the data around that as well. So look at the resources, right? Exports. Over the last 5 years, they've basically plateaued, right, and even starting to come down. So I'm assuming that this will also start to trend downwards as well, with what the details are coming from China not really buying iron ore, or at least putting a stop to it. So you can even see it here. It's the last really 5-7 years, it hasn't really moved up too much. LNG, so the gas industry, again, has sort of plateaued as well. Let's have a look. What are we importing? Services, consumption. Yep, that makes sense. Let's have a look. What else? Well, what else is interesting in this report, hey? Interest rates, that's a pretty typical graph that we see, in the news, or, Jace and Andy typically put these up as well. So you can see how we had, ongoing interest rate cuts, from sort of 2010 onwards. Then we had the pandemic, and then from there we were sitting basically at zero, and then we shot up. What was it? 13 consecutive months in a row, and now we are coming back down, which is good. You can see other nations as well. The most important one is Japan, right? So if you were to look at any of these, Japan is probably the most important one, because historically they have always been at a very low interest rate, and when we say low, close to zero, right? So this uptick here is something to watch, and it needs to be considered heavily into any long-term decisions, because Japan holds a large number of US government bonds. Japan's yen is used for a lot of trading as well. And if you think about it, if you've had sort of 20 or even 30 years of low interest rates, and then they start to go up, that's going to send a shock to the system, even though it's like at 0.5%, or under 1%. So to us, it sounds foreign, but in reality, it's a very important development that needs to be watched quite carefully. There was an interesting one here as well with the 10-year bond. Yeah, 10-year bond deal. Again, super boring, but what it means is that you can go out right now and you can get a fixed interest investment that pays you sort of sub 4%, or just low 4% rate for a 10-year period, right? So which means that you buy something now for say $10,000, and in 10 years it'll be returned to you 10,000, but along the way you're going to pick up 4%, right? So if you're more on the defensive side, something you want to look at. But typically, this is the rate that a lot of economists, a lot of investors use in order to sort of quantify how much risk they're willing to take within the share market, or even like any sort of aggressive investments. What else is interesting here? As you can see, there's a lot. There's a lot of different graphs. You can see that there's the CPI index on different economies. You can see S&P 500, so the US stocks, top 500, outperforming the top 200 in Australia and across the world. Them two you can see that there's a decent gap between the US and the rest of the world in a way. So hence why it's important to be diversified. Have different investments within your portfolio. Yeah. All right. I think that's probably enough, right? You guys are probably bored now with this stuff, but but look, jump on the RBA website, right? There's a lot of interesting information, especially if you are serious about investing and you want to do a lot of DIY stuff. Have a bit of a thesis as to why you're doing certain trades, or you're investing into certain things. Obviously, crypto is another one that they're probably not going to be covering on here, but it's a different scale altogether. So let's have a look, Jeff. You've got a couple of more questions here. So you're already bought, great. So you're happy. Mass layoffs in coal, yep, correct. So there was actually a graph there. I remember looking at it yesterday in terms of coal, and you can see that it's gone bang straight downwards. Job losses all over central Queensland. I'll just share that. That's what I'm reading. Truck drillers, cleaners, cooks, bus drivers, etc. Yeah. So look, there's a bit of a there is a bit of a squeeze in that regard. So that's why the job numbers are so important, because and the interest rates as well, because they're linked. If you are able to give the businesses ability to borrow at a lower interest rate, then you would likely get a little bit of a activity in the job market, right? So people will get back and look at hiring. But whilst the interest rates are high, it's really difficult for the businesses to make that employment decision, because the cost of employing someone is relatively high for that business. So anyway, guys, in summary, rates are on hold. Much of a muchness in terms of the message is that, hey, we're still looking at the data. That will be an indicator. The inflation is likely to pick up. With the 5% deposit schemes come in yesterday, so which means that the prices of housing are likely to go up. If you look at supply and demand, supply is still relatively tight. Demand should spike up, therefore the prices should go up. Again, that's just economics 101. However, we'll see what happens in the next 6 months. So, but if you already got these assets, that should be a great time for you guys to think about, all right, well, why don't I get valuation on my investments and, see what the equity is in there, right? If there's equity in there, maybe you can go again, so perfect timing to lock that equity away or do something with it. So I hope you guys enjoyed this episode. A little bit different, a lot of graphs. Again, if you are listening to this, probably best to jump on and view the video because I do share my screen for 99% of the time. So again, guys, see you all next week. Enjoy your coffee, and I'll see you guys later. Bye.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.